the sentiment data more broadly is I guess on the frothier end of the spectrum. Certainly attitudinal measures of sentiment, maybe a little bit less so behavioral measures of sentiment. I think it's important to understand which indicators fall in which bucket, and it's almost necessity for it to be a contrarian indicator to see it in both categories, which we're not quite seeing it in both of those, but it's on the frothier end of the spectrum. The most important thing I would say, though, is sentiment. Not that anything's a good market timing indicator. Sentiment is a terrible market timing indicator. We can get frothy sentiment and it can stay there for years, as we all learned in the late 1990s. So it's more of a backdrop.
Lizanne, we had a bunch of central banks speaking and issuing announcements last week. And let's just start with the Federal Reserve. Probably came out a little bit less hawkish, I guess is a right way to frame it, than maybe investors were discounting going into it. What did you take away?
So it was definitely on the more dovish end of the spectrum, particularly as it relates to the dots and the expectation heading into the meeting that we might see one of the three rate cuts come out of expectations per the dots. But I think what's more important is Powell continuing to push back on the notion that the dots represent some sort of policy path. They don't, they never have. And certainly in an environment where the Fed is data dependent and not on any kind of preset course, if the data changes, I think their perspective and things like probabilities in terms of the Fed funds future market could change. So at that moment in time, it was slightly more dovish, but the combination of their dual mandates, I think, has to continue to behave, or in the case of inflation, actually roll back over and start moving down again for rate cuts to start as soon as the June FOMC meeting.
So given that backdrop, Lizanne, have you guys altered kind of your allocation here? Stocks, bonds, maybe alternatives? What's the Schwab call these days? Maybe how has it changed over the last several months?
So we don't play the short-term sort of tactical asset allocation game by saying, above or below or percentages, because again, almost $9 trillion of client assets. What might be right for, some 25-year-old aggressive investor that inherited $10 million from their grandparents and doesn't need the money, versus say a 75-year-old who is retired and needs to earn income on a nest egg that they can't afford to lose any component of. So entirely two different messages there. What we have continued to do, though, is focus on factors, even a little bit more than sectors. And we still think you want to stay up in quality. Momentum has been a dominant factor, but what's interesting is that's more of a concept than a factor. Momentum just says, it just says that stocks that have been working continue to work. What you can do, though, because a lot of comparisons are being made to the late 90s, momentum as a factor is doing well right now. That's the same thing happened in the 90s. But the actual fundamental factor that was most highly correlated to momentum in the late 90s was negative earnings. The factor right now most positively correlated to momentum are factors like high return on equity, strong free cash flow, and a negative correlation right now is negative earnings. So momentum is just a concept, but you then have to look at what are the fundamentals of the types of stocks that continue to do well. And I think that's an important differentiation. But in essence, it's high quality other factors that are dominating in terms of momentum. And that is what we say you want to stick with right now. Stay up in quality. This is not the time to go down the quality spectrum.